Welcome to the deep dive. Today, we're jumping into an investment world that, honestly, many of you might never have even heard of. Picture this. You're investing in a lawsuit. Not filing it yourself, no, but funding someone else's case. And here's the kicker. You only see a return if they actually win. We're going to explore this, let's call it, the hidden world of litigation finance.
It really is a fascinating area. High risk, definitely, but potentially very high reward. And it's getting a lot more attention lately. Our mission today is basically to pull out the key takeaways from the sources we've looked at, help you get your head around this pretty unique landscape.
Okay, so let's start with the basics. How does this actually, work? The idea seems simple, maybe too simple.
Well, the core mechanism is pretty straightforward on the surface. You have an investor, could be a specialized fund, who agrees to cover the legal costs for a plaintiff. That's the person bringing the lawsuit. Often, these are solid cases, but the plaintiff just can't afford the huge legal bills.
Right, legal fees can be astronomical.
Exactly. So the funder steps in. And in return for covering those costs, if the case wins, or maybe settles favorably, the investor gets a slice of the payout, a pre-agreed slice.
Okay, but what if the case doesn't win? What happens then? Does the investor just lose that money?
That's precisely it. If the case loses, the investor gets nothing back. Zilch. It's what they call non-recourse funding. The plaintiff doesn't owe them anything back if they lose. So yeah, the funder takes on all that upfront risk. It's a real bet on the case's merits.
That sounds like something maybe kept behind closed doors, super niche, only for big players. But the sources we read suggest it's changing. Is this becoming more accessible?
Oh, absolutely. It's really shifted.
Yeah.
What might have been, opaque deals years ago is now much more structured. We're seeing big investment firms, hedge funds getting involved, and interestingly, even retail investors.
Retail investor? Really? How does that even work?
Yeah, there are platforms now like LexShares or Yield Street were mentioned that essentially let individuals pool money to fund cases, crowdfunding lawsuits, basically. One source even made the point quite vividly, said you could, quote, diversify your portfolio with a divorce case. Shows how specific it can get.
Wow, a divorce case. That's something. So why the boom? Why now?
Well, part of it is just more awareness, maybe clearer regulations in some places. But also, there's just a huge demand for capital from plaintiffs and law firms. And as more funded cases succeed, it builds a track record, makes investors more confident,
Okay, let's talk returns then, because that's always the big question with investing. The sources use words like insane, double-digit returns. How are those kinds of returns even possible here? Sounds almost too good to be true.
It's tied to the risk, fundamentally. Because funders can lose everything. When they do win, the payout needs to be substantial. They might negotiate, say, 20% to 50% of the final award or settlement, or sometimes a multiple, like 2 or 3 times their initial investment back.
Okay, so the wins have to be big enough to cover the losses on other cases.
Exactly. And even if, say, only half their bets pay off, the returns on those successful ones can be really significant, especially on larger claims. That drives the high average returns. Plus, there's another factor, speed.
Speed. How does funding affect how quickly a case resolves?
Think about it strategically. A defendant facing a plaintiff who suddenly has deep pockets backing them. That changes the calculation. The plaintiff can now afford the best experts. They can handle drawn-out legal tactics. They won't be starved out financially. So defendants often become much more willing to settle, and settle faster, rather than face a long, expensive fight against a well-funded opponent.
That makes sense. It levels the playing field, maybe. But that brings us to the ethics of it all. Our sources definitely flagged this as an ethical gray territory. I mean, you're betting on someone else's legal fight, potentially their pain or distress.
Yeah, that's the core criticism, isn't it? Are you profiting from human pain, from delays in justice, from the unpredictability of courtrooms? It's a valid concern. But the counterargument, which also came through strongly, is that this funding actually provides access to justice.
How so?
Well, for individuals or maybe small businesses going up against huge corporations with, armies of lawyers, this funding can be the only way they can pursue a legitimate claim. So proponents argue it actually makes the system fairer. It ensures cases are decided on merit, not just on who has deeper pockets.
Right, so it's framed as potentially democratizing justice, not just making money.
Okay.
But beyond the ethics, what's the big financial draw for investors, apart from those potentially high returns?
This is a really key point. Litigation finance is generally uncorrelated with the stock market. What that means is, if the economy tanks and your stocks plummet, the outcome of a specific lawsuit usually doesn't care. Depends on legal facts, evidence, judges,
Uh,
not GDP growth or interest rates.
so it's a diversification play.
Exactly. It could potentially act as a hedge. Some sources even suggested it might perform better during economic chaos. Why? Because, well, economic stress often leads to more legal disputes, bankruptcies, contract breaches, things like that.
Okay, fascinating stuff. So, turning this back to you, our listener, it's definitely an outside-the-box strategy, isn't it? Something most people probably don't think about when they consider investing. Would you ever consider something like this?
It certainly makes you think differently about where investment returns can come from, doesn't it? It challenges the traditional boundaries. Definitely something to ponder if you're looking at alternative assets, especially ones that behave differently from the main markets.
Because it seems, based on what we discussed, that in the future of finance, maybe even courtroom drama pays dividends.